Hi, I'm Anthony and we're talking money. Thanks for coming back to the channel. Have you ever wondered what the top 5 mistakes that investors make in the stock market? In this video, we'll find out what they are. You'll be surprised at some of them. I know that most people make one or two of these mistakes. I know I certainly have. So without further ado, let's get straight into it. The first mistake you're going to make, and I know I've made this mistake, is trying to time the market. I'm going to let you into a secret. Even though you think you may be the next Gordon Gekko or have some inside knowledge, you will not be able to time the market to your advantage other than by luck. You can't predict the future, you can never time the market to any degree of accuracy, so don't even try. The FTSE 100 or the SP 500 may have just tanked and trading at a 6-month low. Do you sell now and cut your losses? Do you buy into a low market in the hope that the market swings back in your favour? Likewise, the markets are at an all-time high. Do you buy in the hope that the market continues? After all, you have a fear of missing out. Or do you sell and bank some profits? What to do, I haven't got a clue. So no one wants to buy at the top of the market or sell at the bottom of the market, although plenty of people do that. It is counterintuitive, but shares that have reached all-time highs tend to make new all-time highs in the future. That said, shares that have reached an all-time high may actually look forever back at that time, languishing in its shadow. What I'm basically saying is that we, market analysts, Warren Buffett, all those Bitcoin millionaires cannot predict the future. What you can do is have a strategy that takes advantage of any upswings and cuts your losses in the downswings, which very neatly brings me to my next mistake that investors make, and that is not setting a stop loss limit. Those pesky loss-making shares damage your overall portfolio. Now, I hold my hands up. I'm guilty as this as the next person, but I can't tell you how important this error is. The reason why it is so difficult to do, and therefore why many people fall victim to this error, is that you set yourself a stop loss. You are by definition exiting the market at a loss. You hang on in there hoping that the price will turn around so that you can restore some of your lost money. This is the mentality of a gambler. You're not gambling, you're investing. Worse still is doubling down on a loss, just like a gambler does when on a losing streak. The thought process goes, okay, I'm sitting on a loss, but if I buy more now, then I average down my overall buying price, and the price only needs to go up by a little bit before I've broken even over the total holding. Well, if the price does go up, then you're right. If the price goes down, you've compounded your loss. Now let's assume that you are right half of the time and wrong the other half of the time. On all those occasions you are wrong by 1 cent or 1 penny, you lose more than your original stake, and you lose on your additional stake. On all the occasions you are right by a penny or a cent, you are still losing money, since the price has to shift a lot more than a cent, 10 cents or a dollar, whatever, or a pound, before you actually start making money on your overall stake. You have to be right by quite a degree because the price has to shift up just to break even, and then more some to take a profit. You may be lucky, but research shows that it's a loss-making strategy if you average down on a loss-making share. I personally set 2 stop losses. The first is at 20%, but funnily enough, that's not when I automatically sell. The 20% figure for me is just a red siren blaring warning light. I sit up, pay really close attention, and watch that particular share like a hawk. If the share falls by a further 2.5%, so to 22.5% loss, that's when I hit the sell button. There's no scientific reason why I set these limits, but in my own mind, I give the share the benefit of the doubt and give it one last chance to turn things around. Now, closely related to setting the stop loss limit is setting a trailing stop loss limit. Essentially, it's exactly the same as before, but as the share price hopefully rises, so too does your 20% drop limit. By way of a simple example, if you buy a share for £1, normally you set the stop loss at say 80p. But say the share is actually doing fantastically and increases to £2, then the stop loss also rises to £1.60, which again is 20% less than the new price. Trailing stop losses will lock in your profits, but again, they are difficult to stick to because psychologically, you are selling below what you could have sold it to before. Even though you're not making a loss as such, it feels like you are, which is painful. This sounds so easy, and in theory it is, but experience will teach you that this simple concept is much harder to adhere to. The next mistake that investors make is not being diversified enough. That's not having enough shares in total, just having one or two or something, or having too many shares in one particular sector. Now, what this does is interesting. Trust me, it is interesting. What happens is that it exaggerates your gains, all the losses that you experience in your portfolio. Imagine having a portfolio of just one share and you'd invested it all into, say, Tesla 12 months ago. Bingo, you've just gained 400%. You look like an investing god. You could quite easily have invested that one share in Occidental Petroleum, and you'll be licking your wounds with a 75% loss. Now, you could argue that you prefer to make bigger gains at the risk of some bigger losses, but this is not investing, that's gambling. No one knows what will happen to shares next week or next month. Warren Buffett said that you cannot predict the market. You can hazard a guess, make some estimates, but you will never be able to predict accurately. So the best policy is to spread your money over several areas, knowing that some will be winners, while some will inevitably be losers, which leads me nicely on to the next biggest mistake that investors make. Being attached to a share for sentimental reasons. You may have been given some shares, they may have been your first purchases in your portfolio. You may have held those shares for some years, just can't bring yourself to sell them. If this is you, then yes, I'm with you too. I'm sure this is quite a common mistake. I'm not too bad at this now, but I have purged my portfolio, and now I just have shares that meet my personal criteria. But those BT shares that I bought in 1984, my very first shares, I still have, and I should have sold them years ago. I probably should have sold them years ago. Yes, I should have definitely sold them years ago. Looking at the share price now. So don't get too sentimental with shares that you've held. If they're not making you money, if they're not giving you dividends, then there's no reason to hang on to them. Lastly, the next biggest mistake is trading too often. It's tempting to buy and sell and scalp a few percentage gains and bag them as a win. But remember that every time you buy and sell, you pay a commission to your broker, or if you have a no-fee broker, then you're still paying in the price that you buy and sell at. It's better to let your profits run and cut your losses and trade as seldom as possible. Don't sacrifice all your hard-earned profits in commission charges. After all, large increases in price tend to take time, years even. So selling too soon for a small gain is definitely a mistake. I have held shares for 10 years or more, and not for sentimental reasons. They pay valuable dividends every quarter or every 6 months, and I compound this into buying more of the stock, more of the dividend stocks. So if you stayed this long in the video, thank you very much. And as a little bonus, I'll give you a strategy that I use for timing my share buying. As I say, I can't predict the future, no one can, but you've got to have some kind of little strategy. And this is the one that I use. I can't predict the market or time it, but personally, I'll look for the most recent peak in the overall market, say the FTSE All-Share Index, and buy shares whenever the index retreats by 5%. Or if the market falls by 10%, then I'm fully invested. A 10% drop is a big drop in the index. I know we've had recent falls with the COVID crisis in 2020 of more than that, but a drop of 10% is quite a major thing. It may fall further, but I'm not that bothered as I invest for the long term. I'm prepared to ride out the storms, and in the meantime, those dividend checks just keep coming in. That's what I personally do, and it seems to work for me. So I stick to this policy, and over the last 10 years, I've beaten the index 8 times in those 10 years. So, it works for me. I'm not necessarily, this is a strategy that you should definitely go for, just giving you my personal experience. Anyway, I hope you've enjoyed this video and found it useful. I don't know whether you found it useful or not. Put it in the comments below if you have or haven't, or if you've got any strategies that you use, and also put in the mistakes that you think I've omitted here. Anyway, if you've enjoyed it, then hit the subscribe button and the notification bell, and I'll see you in the next video. Until then, I'm Anthony, and as always, we're talking money. Bye for now.